Today we're going to talk about real estate appraisals and appraised values. Welcome back to the channel and thanks for being here. If you follow real estate news, or perhaps you're even currently looking to buy a new home, you may have heard the terms appraisal or appraised value before. But how do appraisals affect you, and specifically, what risks should you be aware of when buying real estate, especially in a hot market? A little forewarning, we're going to be doing a little bit of math.
Boring.
I know, however, it's extremely important and could cost you tens, if not hundreds of thousands of dollars if you get it wrong or if you're unaware of its impact. First off, let me explain what an appraisal is and what getting one entails. An appraisal is a report created by a certified professional that banks and lenders use to know the value of a property for the purposes of providing a mortgage. There are two types of appraisals that can be utilized. One is called a desk appraisal and one is a full or standard appraisal. You may say, don't both provide the property value, so what's the difference? And you'd be correct. However, the primary difference is the speed in which the reports can be completed. A desk appraisal is much quicker and can be done literally behind a desk. You often get the report with the appraised value back within 24 to 48 hours. A full appraisal is more comprehensive and often requires an on-site visit, including interior and exterior photos and sometimes even measurements. Which type of appraisal is utilized is chosen by the lender based on the property and the credit profile of the borrower. Now, the object of any appraisal is to come up with the appraised value. If you've just written an offer and have an accepted deal to buy a house, you're hoping the appraised value is greater than or equal to your purchase price, as this is what the bank will lend on. However, we get into trouble when it comes in less than what you have offered for the property. It's time for that math lesson. Let's say you need a 10% down payment based on your lending requirements, and you have an accepted offer on a $500,000 property. Assuming the appraised value is exactly $500,000, this would mean that the bank would typically lend you $450,000 and you would put $50,000 down. Or a better way of putting it is the bank will lend you 90% of what you need to pay. But let's say the appraised value comes in at $480,000. What then? The 90% the bank will lend you now only calculates to $432,000. Therefore, if you offered $500,000 and the bank will only lend you $432,000, your actual down payment required is going to be significantly more than the 10% down that you had planned for. Do that same math on $1 million property and you can see that it is easy to get into a deficit well into the six figures. In hot real estate markets where multiple bids are common and competition is strong, it is easy to get caught up in the buying process and write an offer higher than it may appraise for, without any subjects or conditions to protect you. In the situation above, you could be forced to come up with more money than you may have or risk breaching your contract. That brings up a whole other slew of issues I'll maybe discuss in a different video. If I do, check the link above. There are certainly ways to mitigate your downside, and every situation is slightly different. Be sure to discuss with your real estate professional regarding your specific situation. For today, just remember, be aware of the risks when writing an offer without any subjects. It could cost you. That's it for me for the day. If you enjoyed the video or at the very least learned something, let me know in the comment section below, and don't forget to hit the like button. If you haven't already, please consider subscribing to the channel. Other than that, thanks for watching and have yourself a great day.